All right, ladies and gentlemen, welcome back. Chart Talk coming at you. It is May 2nd, 2022. Just completed April, the worst month for NASDAQ since 2008. So things are looking glum. We got a little bit of a bounce back today, but without further ado, let's jump right into the market outlook. So, stocks, it was Friday to close out last week. Very, very grim day. Huge sell-off. Sell-off was a bit overdone, but, we're just in this downtrending bear market. And, this is the type of action we should expect, this extreme volatility. Since we broke down, I got the S&P up on the SPY up on my screen. Since we broke down late April, we've been kind of following the 8-day simple moving average down. Whenever we get overextended from that level on the next push down, that's kind of when we get that bounce back, which is what we saw today. But, I wouldn't say today's a bottom. We got the Fed hiking rates. This Wednesday, it's going to be a very big Fed meeting. We got a 50 basis point raise coming. And, I'm trying to make sense of how long we should expect this whole downtrending market, this whole bear market to really last and really, how long we got to deal with this, right? Mm-hmm. And we have this rate rising environment. So I looked to 2008, and it's very interesting the similarities that we're kind of seeing. So what happened in 2008 was, they began the bear market, and the duration was 13 months or whatever, and which puts us at like month 4, whatever it was. And the cycle that we saw then was very similar to this cycle, where growth stocks got pummeled to start. And then that's when energy and things like that began to lead. And then once those names gave up the strength, that's when the tape started to speed up to the downside. That's when markets really started to sell off. Then about 3 months after that is when we got the bottom. And March 2009 is when breakouts started proliferating left and right. So, who knows when that's going to be. But I thought it was very interesting that commodities had this super cycle in 2008 as well. And that's kind of what we're seeing now. Then we did see them fall off at top. We look at, I'm going to bring up oil for a second. Oil still looks pretty good, but, do they have enough strength to, reach those new highs again? We saw those names starting to begin to fall off. So I'm not sure where we're at in our cycle. I just know we can expect volatility from here on out. That's really the only expectation. And times like this, it's difficult in the chat and such because, we're seeing the people who have most success. They're just trading the S&P at the SPY and the NASDAQ back and forth. There's not a ton of setups that are working out in either direction really because there's such extreme chop going on in both directions. So it's really hard to have calculated entries in anything but the market when everything's just following the market so closely. So just kind of staying pretty risk off. If I see market trades in there, I'm going to get more involved. I have a huge list of earnings names that responded well to earnings, and when we go on favorite charts, I'll talk about them a little bit more. But the guys who are having most success are really just trading the market back and forth when we get to these extremes, when we're extremely overbought, when we're extremely oversold, and when that's the only setup in the market, it's not a very risk on time. You got to be very precise, and I don't really love trading the market. I've been doing it so much the past 6 months because that's really been the best setup out there. Today we had the oversold SPY. Huge bounce back. A lot of guys did well with it. Friday, it was a bull trap, and a lot of guys got short. Same thing. And that's if the best trade setup in the market is the SPY, it's not a great market. That's really the way I'm looking at it. What are you thinking over there?
So I'm actually looking at. I have the daily up for the SPY, but mine is going. I guess from I'm looking at the SPY chart basically 2003 to 2009. And like you said, very similar. Like we had that breakdown going into 2003, from the dot-com bubble, we had that run up back to high. So from its post dot-com lows, 2003, 2004, back to its high, that was about 100% run up, but that took nearly half a decade. So we saw very for like post-pandemic to where we're at now, we saw very that breakdown, that 30% crash to that 100% run up off lows. And then if you're looking at like March 18, I guess March 20th, 08, we had the market on a rolling over. We had this kind of H over in the SPY at that point, and it held kind of perfectly. We got that bounce into like the 200 day, it was maybe like a 10% run off lows, where this seems like this, and I don't know if you're at the same exact spot on the chart, Jake, but like looking at that action then reminds me of kind of what we're at now, where the market looks so crappy in the short term, like so overextended. It looks like the market's going to roll off like over a cliff, but it might have one of those little short-term bounces that it could, still have one of those little bounces into the 200-day. But when you draw out this like bigger range that we've been in, if we do break this low, this 410 lower, or call it 400, with some like downward momentum, the measured move of this breakdown is like 50 points lower, which is like SPY 360. And then if we continue like in 08, where we're just lower lows and lower highs, we eventually just keep that like stair step kind of pattern lower.
Right.
So it's like in the short term, like I feel like we can still kind of get a little bit of a bounce into the 200-day, just because everything looks so bleak. Everything just looks so negative. But again, there really isn't much setups out there. But we're still so oversold, just like on the flip side, where, end of March, beginning of April, when we were at SPY 460, everything was great in the world. We were a chip show away from all-time highs again. Everything looked great. And that was when like a lot of people wanted to be the most risk on. And now on the flip side, now when we're near support, where, buying up through 416 versus, 405, you're risking 2% here, but you can be a part of, say, an 8 or 10% bounce. You have much better risk reward than loading the boat at 460 after the 10% run and expecting that continuation. So, but again, individual like sectors, REITs, kind of a disaster after that recent little bounce it had, right back to its support. Materials, dead smack, middle of the range, looked really crappy. Healthcare was ticking basically new all-time highs at the beginning of the month, and it's about to be ticking basically new 52-week lows 2 weeks later. So it's just a lot of back and forth action. Consumer staples, new 52-week high 2 weeks ago, back in the middle of its range. Utilities, new 52-week highs 2 weeks ago, back in the middle of its range. And then we have telecom in this very obvious downtrend, just a very big avoid. Biotechs still in a very obvious breakdown stage, same thing, big avoid. Industrials, same thing, breakdown stage, a big avoid. And then we have the consumer discretionaries and the tech sector, both like hovering at this major support level, similar to the SPY and even kind of the NASDAQ, where they look so bad. But these are kind of where you can get those like very low risk shots, where if this area is going to hold, you can get some low risk stock broadly, where if there is a 5, 8, or 10% bounce, you're risking 2-3% down here. And it's, if it rolls over and heads lower, it's, 1 or 2% loss. But again, it's, scanning all the charts, even the pre-market call is, 1 or 2 ideas, not much from an active trading standpoint for sure.
Right. So with that, you want to get into some top ideas?
Yeah, let's do it.
So, I have this huge list of earnings names that all responded very well to earnings. I'm just waiting for these things to set up. Now that we got a bounce back in the market today, some are looking a little bit better. I'm going to go to a few. And obviously, I'd love more, much more consolidation out of these guys. But for now, let's get into it. So, PTC, this is one of them. Huge gap up on earnings. Gapping right up to that downtrend line. Give us a couple inside days. If it can make a huge break over this 118.50 area, that could have legs. But again, all of these are so dependent on the market action. It's brutal. Making the newsletter on weekends when the spot S&P just sells off dramatically 4% on a Friday is the worst, because every single chart looks so bad going into the weekend. But now we're getting a little bounce back. This MXL, here's another one. You can see it was this previous support area. It's trying to turn into resistance, and it's consolidating in front. We had a nice little gap up on earnings. Now it's consolidating. If it can make a move over this 52, 53 area, that one could get going. CHDN, Churchill Downs. This one has a nice little downtrend, nice little consolidation it's working on right here. If it can break above this 220 area, that could get going. AN, this one kind of broke today. I would have loved to see a lot more sideways action out of this one. It's not really giving us a great chance. They had earnings down here in this 105 area, so it made a huge move off the earnings, consolidated right on top of 200-day. Now it's starting to blast off a bit, so that chart's looking pretty good. But again, it's not something I'm dying to buy today. Another one is this OC. it's within a huge macro consolidation. We head to a weekly chart. You can look back and see this massive cup and handle on the long-term chart. But in the short term, you want to see it take out this like 95 area to start. Then it can go after 100. So, that one's on the radar. Where are we going from here? GLW. This one had a nice little gap up off lows on earnings. Just consolidating that market gap up. And now we want to see the next move higher would be over this. What is that? 36 area, 37 right there for that one. CHRW. This one needs a lot more time. But again, this 112 area, massive resistance level. Gaps right up to the level on earnings. Strong move. Remains strong. It didn't pull back too much. It sold off the market Friday, but everything did. So now we give us a couple weeks of sideways. That 112 could be in play. DRVN. Somewhat recent IPO. Held that 26 area support, ripped higher on earnings, and now if we look for a move through 29, that one can get going for the next leg. Next resistance there is like this 32 area. And last but not least is Mattel. This one's been a buyout target for a little bit, so it's been popping on that, but also had a great reaction to earnings. Traded around 52-week highs, very rare to say in this market. So through that 25 area, 25 quarter, that one looks pretty good. But still, so charts with today's action, charts are starting to look better for a little bit. The strongest of the strong charts, the ones that reacted best on earnings. But I'm not going into tomorrow gunslinging. For the SPY, I think we kind of, I think we continue to bounce. But I think we have to see what happens with that 8-day simple moving average. That's where we've been selling off from. And again, Wednesday we got the Fed big Fed meeting. We get that rate hike. So much news this week. This is going to be a very tricky week. We're going to see a lot of chop back and forth. What do you got? You got any charts over there I didn't mention?
So main one really, I think the best chart out there, I think, is this PG right now up through this 165. It definitely is still needs time to tighten up and develop more, but that resistance level is just so defined, that 165 blue sky breakout, low beta kind of consumer staple name. So this would be one, up through 165, but again, this might take a few months to really develop, but this is definitely the best chart I could see.
Yeah.
Only other one really is this IT up through this 310, this little base. Really the base is versus this 316 versus kind of 280, but you can kind of sneak in up through 302, 305, 310, in those little areas. Just a name that's kind of been holding up, given how weak the market's been. It really hasn't pulled in too much, even on Friday, for how crappy most names traded. And this is a tech name. Tech names were getting smoked, and this name was just kind of holding up in this little base. So those are kind of the only two, really slim pickings out there, I think, just broadly.
Yeah. No, I'm definitely with you there. It's definitely a tricky time. So good trade, bad trade time?
Mm-hmm.
All right, so let me start with the bad trade. I only have 2 trades to go over. I really only took 2 in the past few days. Last week I was telling you guys how I pretty much de-risked a bunch of those oil names into the new highs, things like that. Mm-hmm. And the only thing I really did to long side last week was this KDP. This is on my earnings list. We actually saw these value names. This shocked me today that these guys got hurt the most. So tech responded really well today, and then more of the value, low beta stocks, those are the ones that got rolled over and hit the most. So I bought this one Friday. I bought this 38.25 area. When it reversed lower, I got out of size, but I wanted to give it the true room, this 36.50. I thought it would hold up, maybe give me another pivot to add off of. Never gave me that pivot, just kind of died today. No love at all there. My mistake in the trade, I was definitely adding a little too much Friday. It would have needed to be this perfect breakout. And you can see on my chart, I kind of added this size and got out, pretty shortly after. Because I was thinking, what am I really expecting out of the market here? Is the market going to rage 4% and bring this KDP up with it? Probably not. So I bought some size, I got out of size, I got out more size here. And then, when I gave it the true room, that's why I took the official loss. The one good thing I did last week, Friday, I shorted the Qs. After seeing that Amazon and Apple earnings, both were not good earnings. Amazon had straight up bad earnings due to inflation and supply chain. And I look at, I've been saying this a lot. I look at Amazon as the, consumer behavior indicator, because everyone I know is ordering like crazy off Amazon. So if they have bad numbers, it's just a signal for the rest of the economy. In my eyes, it's not, that's not in textbooks or anything like that. But what I did on this Q short, I had a bearish thesis going into Friday. So we got that move higher, then we kind of stalled. And these names were mirroring Apple and Amazon. Apple and Amazon popped highs for a little bit. Then they started, tucking back under those levels. So I got short a little bit, and then I added size when we broke, this previous intraday, previous kind of resistance intraday. We tried to pivot off it. Then once we broke that pivot to the downside, I added heavily. So I took some off 1-to-1 just to pay for the trade. Definitely took a little too much off there. Looking back. Who could expect a 4% down move in a few hours? But, in this market, I have no problem with, just being a little more defensive. Took some more off into weakness. And then, this morning when we began to reverse, I took a majority off. I still have a tiny piece. I want to see if it gives me another opportunity. I want to see how it handles this, this 325 area, honestly. Because I think the market's just gearing up to just smoke these lows. I don't know if it's this week, next week, or what it is, but it's just too obvious a support level for me. Again, the only thing, fighting back against that is everyone I talk to is bearish. So that's usually like everyone I talk. And I'm going over charts and I'm like trying not to be as bearish as I am. But the charts are just disgusting out there right now. So I traded that NASDAQ wallet. It's still a small piece, but that's really it. I'm much more hands off until after this Fed meeting at least, and until charts start to look better. Really, what you doing over there?
No, I mean, when you said that everyone's bearish, I was the same thing where it's like I realize we could still ease it, in time still push down to 360, but when the market's at lows, it's easy to make that claim, right? But it's hard to say that SPY 460. It's hard to say we're going to 360 in the SPY, because dude, we're up so much. Where when everyone's thinking that, it's and we really only need one or two strong days, and then how crappy the market looked, then then you get one or two good strong days, and then everything kind of shapes back up and looks good again.
Yeah, well, you even look at today's reversal. I didn't have any of these charts on the shakedown on the newsletter this weekend because everything closed so weak. Now that we got a little bit of a bounce back, the best of the best are starting to look better. I wouldn't say they look good yet, but we need to see a few strong days out of the market before we really start to make any big claims.
Yeah, we don't have to be running into the fire when it's just starting.
Exactly.
Yeah. But for me, trades, I really was just doing nothing. Again, I'm looking at my trades in my tweets go GD. That was a 0.5% loss. Names almost 25%, 25 points lower than where we got out. OKE. Yep. We did a great job of that one 2 weeks ago. We were getting out 73, 74. The stock's $10 lower now. And that's just I think that was one of those really good examples that I think we noticed very quickly with energy, where it looks so perfect. Yeah. And the more perfect I think a name or a sector is going to look, usually that's
more red flags.
The end, and that's even with the 10-year right now. The 10-year is ripping, and it's that same. It reminds me just the chart, not the 10-year rates and all, just the chart of how this dramatic move it's had. Reminds me just like VDE, where it had this dramatic move. It looked so perfect, end of April. We got that last little kind of push where we all were getting pretty heavy in energy, and then we all were quickly getting out of it. Where TNX, this is that last kind of little push, and maybe this is kind of factoring a lot of the rates rising and everything, that they're kind of anticipating this, that maybe going into Wednesday, everything is status quo, there's no surprise, and then maybe the 10-year does start to fade, the market catches some bids, and maybe we push back up into the range. But that's my big thing for the good trade, bad trade has just been looking at my most recent trades and the fact I got out of those and got into cash, and just doing nothing. It's I'm not frustrated with the market. It's
right. Mental capitalism highs. When good times do come back, I'll be super ready for them. I don't need to have max risk on every day. And what you said about VDE, that's why I kind of brought up the 2008 thing. It was really surprising to me to see that they also had the super commodity cycle, the super stage 2 breakout in 2008, and then once those names topped, that kind of began the the expedited selling in the broad market, and that's what I'm kind of wondering if we see. I don't think energy makes a new high VDE, so I'm wondering if it. Oh, ho, ho, ho! You all good over there?
Yeah.
So I'm wondering. I saw some people saying, what was the stock? That I saw some people saying Oxy looked good in this 58 area. I think the top's in, and I think this is just going to be another opportunity to short when it gets up to the 62 area. Again, I could be very wrong. It's a complete speculation, but that's just kind of what I'm thinking out of this cycle is these commodities come in, and then we get another very swift down move in the S&P over the next few months, and then that's when we might be able to get to a bottom. And my thinking with the Fed right now wants to raise rates. They want to do 50 basis points this week. They want to do 75, and this is just not what they want to do. This is what the futures markets are pricing in. 50 basis this week, and then in June they want to do a 75-point hike, and they want to end up between 2.75 and 3.25 at the end of the year. That's over 90% chance right now. That's what futures markets are pricing in. That's not me. That's not whatever. That's what the markets are pricing in. So if at any point this year the Fed says they want to slow down on that rate rising cycle, that's when I think we rally, and who knows if that happens or when it comes, but that's kind of what I'm preparing myself for. And, I think it's just back and forth chop until then, really.
Yeah. So even like I have the 10-year up, and I have the weekly, and we can see like 3.2 has been resistance for a decade now. And we're less than 10% away from that major resistance that we haven't seen price above that since literally.
And this thing's moving 10% every week.
Yeah. So it's like this is like this run up to 3.2% in the 10-year reminds me very much like energy now, where like if you look at VDE and you look at like the weekly, let me clean my chart.
Oh yeah, it's kind of perfect how
it's like that same, call it 120 in VDE. That's that same not decade, a half decade, whatever those many years are, 7-year resistance. Those are kind of like those major levels, and you can even kind of go back to 08, like these resistance areas where it can run up to that and look as bad or as good as the person wants to interpret it, but like the resistance is still going to be resistant. That's still a major level that sellers are going to come into play and kind of hold those areas down. Where, especially with the 10-year, that's a significant level that even if they want to raise rates, technically there's still going to be some resistance in that spot. But the only other thing I know we've kind of been talking about, like comparing 08 to now, the big difference that most have to be aware of is the length of time that these cycles are like happening and how much faster they're happening now. Like peak to trough in 08 was 2 years. That was a very long, painful 2 years. Like with just the market itself. Again, I was like very young at the time, but I remember watching like American Express go from 80 to 60 to 40 to 30 to 20 to 10 to 8 over 2 years. Like just a slow pain, like ripping a Band-Aid off as slowly as humanly possible. And as the years have progressed, we've just seen these cycles happen much faster and much more accelerated. That even the pandemic, that was 30 days, and a few months later we're back at highs. Where even if we do get this drop to 360 or this drop to even lower, these cycles are happening at a much faster rate. That it's good for the impatient person, but you have to just be a little more patient to let them kind of flush themselves out, and it won't need as much time as most often think it's going to be.
Hope you're right.
Yeah. So with that, Shake, you want to get into book of the week?
Yeah. So I'm still reading this Miracle Morning. I want to highlight one part of it that I've been using lately. It's been really good. So Miracle Morning, it's like you do like this kind of 6-step but every morning, you get exercise, you meditate, some blah 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 blah. But the main thing I want to do is talk about is sitting in silence every day before the market opens. So I usually have on CNBC, or I'm usually just some sort of background noise, and I've kind of gotten rid of that. So every there's like 30 minutes in the morning where I'm just sitting in silence, and you'll be very surprised how clear-headed you become just sitting in silence, just sitting in absolute silence for 30 minutes. Maybe I'm doing work, maybe I'm like getting prepared for the day. One of the biggest things I always messed up with trading is I'd always be so excited for the open, and then I'd put on a ton of risk first 5-10 minutes of the day, and I'd kind of screw myself because it's just choppy off the open, And I'll take an early loss. That was always my thing growing up in the market, like what I would do to F myself. But sitting in that silence, getting the clear-headed thoughts, it really lets me game plan for the day. I kind of visualize the different scenarios I think could happen in the market, and it's something I highly recommend for everyone. Just sitting in silence, 15 minutes a day. It'll help you a lot more than you really think.
It's funny you mentioned the noise in the background and like kind of a little bit about the prop days, with being so excited to trade the open. And earlier today we did like a trading Q&A with Heaven and a couple members, and it was like I had like this same exact story where they were like, "What's your routine like?" And I'm like, "I have no CNBC playing, no Squawk Box, no news. Like it's quiet in my office in the morning. I'm not listening to anything. I'm not being distracted." And I compared it to when we traded at the prop firm, where we had the Squawk Box, we had all the CNBC and NBC on and everything, all the chatter.
The guy in the loudspeaker.
Yeah. And then it was like you were there from 7 a.m. or 6:30 a.m. until 9:30, and 9:30 you're just like so amped up now,
right?
Because you've been sitting here for so long and listening to all this shit for 2 hours that you just want to start doing stuff. But then you look back at your stats and you're like 9:30 to 10 is my worst period trading
Career
ever.
Worst, yeah, exactly.
So it's like just waiting that extra half hour, and it's funny that you mentioned that because I was really talking about the same exact thing earlier today. But for my book, it's Unshakable. That's like our book of the month that we've been sending out to the members that are in the book club.
That's a good one to read right now.
So Money Master the Game is like the bigger version of that book. It's like 600 pages. It's kind of like a doozy. The Unshakable is kind of like the Cliff Note version of that book. Very condensed, 200-page book, very easy read. And the big takeaway from that book, at least for me, that I got was when he kind of debunks mutual funds. And it really, the answer is just, the fees, like that, how costly they are, and the fact that most mutual fund managers, you think like Kathy Woods, they don't really have their money in the funds as much as most would think. After kind of reading to that, I went into my own kind of rabbit hole and like went into that, because before that I just figured some mutual funds did well, some didn't, and that kind of started like the hunt of like, all right, let me look deeper into this, and then after looking through 8,000 of them and finding 20 out of the 8,000 that beat the market, it kind of really hammered in that thesis of why these mutual funds were a very popular product over the years, and now they're just not as popular. But very easy read, more long-term financial related topics, but definitely a good one. And even now it's like a couple bucks off Amazon, nothing crazy.
Yeah, there you go. All right, anything else for the kids?
I think that's it.
All right, with that, folks, Chart Talk wrapped up. See you next week.